Joining me now is Jared Woodard, investment and ETF strategist at Bank of America Securities. Jared, it's great to have you here. You've got your finger on the flows, and you're also a little cautious on stocks here.
That's right. I'm glad to be with you because this is one of those years in which active asset allocation, I think, is more important than ever. Investors are really bullish on big parts of the market, but our contention is that this is a year of slowing economic growth, of a gradually weakening economy, and that means we expect some parts of the bond market, especially the credit-sensitive sectors, to outperform equities. We think there's some great ways you can invest without taking on excess risk, without buying things that are already, too expensive. And if you do that, you can achieve better returns than investors have had for a long time. Because in a world of structurally higher inflation and interest rates, the old asset allocation playbooks don't work. You saw this last year. Stocks down, but long-term treasury bonds were down too, down 30%. A conventional 60-40 portfolio served investors really poorly, and that's why we think it's so important to look at alternatives in the bond market.
I'm surprised when you're looking at bond market alternatives that you're thinking about or primarily doing so through ETFs, which are generally seen as a risky way to play bonds because they mark to market losses immediately.
I understand the point, but in some ways I would look at ETFs in fixed income as the market. Indexes are just lists of bonds that exist. But ETFs are actually traded. They give you a much better view of what's really possible in the market today, where the liquidity really is, and what's actually moving. We think that fixed income ETFs, while they're passively constructive, are incredibly important as a way to allocate assets actively in a market as complicated in this one. And so whether it's sectors like high-yield corporate bonds, high-yield municipal bonds, convertibles, or even preferreds, there are ways to get yield in this market without taking on inordinate amount of risks, and I think most importantly, not taking on the risks of exposure to higher inflation and interest rates that so many investors have done in the years past.
Yeah, you're emphasizing, you can get preferreds at 7%, although there's a lot of those often are financials. There's some questions about that. Munis, we were talking about that yesterday, some nice yields. But again, if I were a muni investor, I'd want to just hold it to maturity. Why deal with the stress of having to watch the market gyrate, year in and year out?
I think it's incredibly important to be diversified, whether it's in stocks or in bonds. And one reason we like fixed income ETFs so much is that they give you a diversified pool of bonds. Your default rate, the risk of some kind of surprise is much lower in a diversified pool of those assets, and you can have much greater control over the sort of exposure to the market that you want. Today we find in the case of municipals that you can earn 100 basis points, a full percentage point more than comparable maturity treasuries or even higher yielding parts of the municipal market. Whether it's in preferreds or convertibles or even emerging market debt, there are places to go today in a diversified pool of fixed income assets that we find give you a much better risk profile than the conventional bond indexes that so many investors have tracked.
That's interesting. I remain, I don't have a strong enough stomach for it. I think there's something about the security of kind of single security selection. But let's zoom out for a second and talk about, what are investors looking for? A lot of them right now are probably wishing they were in, all the big cap stuff, all the equity stuff so far year to date. But everyone also knows you jump in at the end of the rally and you could get steamrolled.
That's right. In fact, the big equity indexes, I would argue, are more riskier than ever. If you bought the S&P 500 ETF 30 years ago, it's 30 years old this year, that was a really diversified basket of stocks. Low correlation to each other within the index and low correlation to other assets. Today, the index is more concentrated than ever. 7, 8, 9 stocks comprise 30% of the index. And the members of the index are more correlated to each other than they ever have been before. That means that those conventional equity investments, any index, any ETF you look at, may actually be much riskier than it ever has been before. We think that looking deeper into the market, whether it's by individual factors or sectors, is a much more prudent way to go. And the same thing's true in the bond market. Most bond indexes own 70% or more in assets that are incredibly at risk from structurally higher interest rates and inflation.
Right.
You saw Chair Powell talking about this again today. That's why we think you have to look beyond those conventional bond indexes and asset allocation models into specific parts of the market where you can get some yield at a prudent level of risk.
A quick last question, because I do share David Einhorn's concern that the S&P has become a price maker more than a price taker. And if I said, okay, I want, ETF stock market exposure, but not in the S&P 500. Are there ways to do that, to get that?
Absolutely. So some areas we like within the market, small cap value, which has been a consistent outperformer over the past 100 years by a wide margin. VBR is an ETF we track that covers that part well. If you want high quality stocks, stocks with really high free cash flow yield, there's a cash cows product we like, the ticker symbol's COWZ. We think that for a long-term investor, metals and mining is going to be incredibly important, whether you care about decarbonization or national security and resource nationalism. Doesn't matter your politics. XME, the metals and mining ETF, gives you exposure to the raw materials that are necessary for all of that. If you invest in these ways, capturing factors and themes in the market, you can avoid some of the overvalued stocks that are dominating today.
You know, it's nerve-wracking breaking from the crowd, but I appreciate the strategies and the advice on how to do that. Jared, thanks for your time today.